It's a big week for Canadian banks. They're releasing their earnings and TD kicks off tomorrow. Our guest says he does expect three of the banks to beat expectations, but the industry as a whole, the six big Canadian lenders, face the dual challenge of shrinking margins and higher credit loss provisions. We are joined by Nigel D'Souza, financial services analyst at Veritas Investment Research. It's great to see you.
Thanks for having me.
So you reckon that we won't, in fact, see a peak in the provisions for credit losses until next year, fiscal 2025?
That's right. If you look at historical credit and interest rate cycles, what we typically see is that credit losses peak within 2 years after debt servicing costs have peaked. So debt servicing costs for households are expected to peak this year. That's with wage growth and with interest rate cuts that have already started by the Bank of Canada. So if we get the debt service ratio, DSR, peaking this year, that means credit losses should peak sometime within the next 2 years. We think 2025 is when they peak because the banks can now provision for performing loans where they couldn't do that in past cycles, and that pulls forward credit losses. In previous cycles, you could only provision for impaired loans, but under the new accounting standard, IFRS 9, they can take provisions for loans before they become impaired.
So things might look worse than they actually are?
Well, the total amount of provisions doesn't change. Only the timing changes. Oh. So because you can provision before they're impaired, it pulls forward provisions, and you just have the peak earlier than you would in previous cycles.
Talk to us about TD. The Globe had a big takeout on the weekend about the mess, this money laundering investigation. For one thing, it was interesting. Apparently, an individual in America pleaded guilty to a money laundering scheme that involved, allegedly, the bank's branches. But it was 2 years before they replaced the global head of anti-money laundering. Has the bank been complacent in its reaction, do you think?
Well, I think the broader issue here is that when you look at the AML issues at TD, and we've had AML issues also pop up for other banks. For example, RBC's U.S. franchise, City National Bank, also had some AML issues identified by the regulator and had a consent order that they're working towards fixing. The difference, I think, for TD is that we actually had a criminal activity take place where we had money laundering occur at the branch level. So they need to invest heavily to fix that. And the broader issue here is that this isn't a quick fix. You look at instances where banks do have AML issues without any criminal money laundering occurring. It takes 3 to 4 years at minimum to resolve. With actual issues occurring and criminal money laundering taking place, this could take, we think, 5 to 10 years to fully resolve and no longer be an issue for the regulator. Oh my
goodness, 5 to 10 years. They'd be under special monitoring or something like that.
They'd have a consent order by the OCC. You can also call that cease and desist order, but there's going to be a bunch of requirements laid out by the regulator, including probably having an external compliance committee, submitting a business strategy, prohibiting any new business activities or acquisitions. And really, they need to satisfy the regulator that they have invested appropriately to fix their risk infrastructure, they have the right amount of staff in place, and that it's not going to occur again. Again, 3 to 4 years typically when there isn't an actual AML event taking place. When there is one, there's going to be more scrutiny. So 5 to 10 years, I don't think is an unreasonable expectation.
The only buy rating you have right now is National Bank of Canada. Why is that?
So there's a couple of reasons, right? On fundamentals, the banks that are going to outperform are the ones that do best on risk-adjusted margins. So that's your net interest margin and credit losses. National Bank is less rate sensitive, number one. Number two, it's focused heavily in Canada and Quebec specifically, which has lower credit losses through cycles. And number three, it has, I think, the best strategy, which is Canadian banking that generates the highest ROEs, supplemented by wealth and capital markets. And it decided not to enter into the U.S. banking industry, which we think has been a drag for a lot of its peers.
I may have asked you this before, Nigel, but is there a case to be made that Canadian banks should just stay in this country where they can earn the high return on equity? I mean, do stuff abroad, maybe on a small scale, but big U.S. acquisitions, I mean, they make grandiose CEOs feel good, but are they a good idea for investors?
I think you nailed it. That's our thesis. We think the best strategy is stick to Canadian banking. If you want to go internationally, focus on wealth management or capital markets, not U.S. retail and commercial banking. Because the ROEs for U.S. retail and commercial banking is sometimes single digit, below 10%, but usually around 10%. you get 30% or higher in Canadian banking.
Whoa.
Right? And if you think about risk-adjusted returns, wealth management, all the risk is off balance sheet. It's indirect market risk. There's no direct risk. In capital markets, if you manage your risk effectively, there's very little tail risk in that business too. So there's a lot more credit loss content and risk and instability in the banking industry in the U.S., coupled with lower ROEs. So we think it's a losing strategy to pursue growth there.
So that plain vanilla banking in America is only 1/3 as profitable as it is in Canada?
Yep, the regulators are a lot more intensive in terms of capital. They have to hold a lot more capital in the U.S.
Oh, okay.
Leverage is half of what it is in Canadian banking. It's also a much more competitive industry, so profit margins aren't as strong in the U.S. as it is here in Canada. And you have lower fees because there's more banking competition for fees as well. So more competitive industry, more than 4,000 banks. And the larger systemically important banks in the U.S. have a significant advantage that the regional banks don't have. So you'll see more consolidation in the U.S. banking space, but going after a low ROE business is not, I think, the best strategy.
You have sells on BMO and CIBC. CIBC stock has been doing well, as I'm sure you've noticed, still down from 2022. But why are you relatively pessimistic on those?
So I think it has to do with credit loss expectations, right? So for BMO, we think more credit losses are due, and that's, I think, playing out because of its U.S. exposure and also U.S. commercial real estate, U.S. commercial lending. For CIBC, if you look at past credit cycles, typically it tends to experience higher credit losses than peers for the exact same type of businesses. That hasn't happened so far. We haven't seen any real deterioration in Canadian banking. We've seen deterioration among renters, but not amongst homeowners. So if we get higher unemployment rates, maybe softer real estate prices, that might start coming through. But it hasn't shown up yet for CIBC. So it remains to be seen whether or not we'll be correct on CIBC's credit experience. And
then, of course, you have a fairly unique terminology at your shop. You have reduced ratings on Scotiabank, TD Bank, and RBC. Can you remind us, what does a reduced rating mean, Nigel?
Sure. So reduced rating is an expectation that the stock will underperform its peers, right? But there isn't significant downside risk. So we think Scotia, RBC, TD Bank, they're going to underperform National Bank, but they're probably going to do better than BMO and CIBC. And we view Scotiabank and TD Bank as having issues on fundamentals, but being fairly valued and pretty discounted. And RBC being strong on fundamentals, but being a little bit expensive. So that's why those are reduced ratings.